of years, we'll be going over the S&P 500, ETF ticker symbol SPY. In this video, we'll be going over the day-by-day probability model, how we find the models, and we'll go over the forecast model for the S&P 500. So back to technical analysis, we are down 84 basis points on the 1 hour chart. We are slowly approaching to oversold RSI. As for the 4 hour chart, we are nearing oversold RSI as well. We approach negative MACD. And as for the daily chart, we are finding support around the 18-day moving average. Once we get there, I do see that we may rest on that level. Reason why, we see past resistance around the price of $331.50. At 2 instances, we have one back in January 21st and one in February 6th. And since we're above that price or above resistance, that now act as our support. And as for resistance, if we were to reverse and head up higher, the next resistance will be the all-time highs of $339.08, which was made back in February 19th. So if we were to move up higher, that price movement is roughly around 1.4% to the upside. And if we were to rest on the 18-day moving average support, that will be around 50 basis points to the downside. So back to the day-by-day probability model. As the days progress to the 7th day, we see a slight chance for the S&P 500 to climb between 0 to 2% higher with a 60% chance. And on the extreme case, we have a 10% chance for the S&P 500 to climb between 2 to 4%. And as for the downside, we have a 25% chance for the S&P 500 to slowly drift lower between 0 to 2% down. And in an extreme case, we have a 5% chance for the S&P 500 to fall between 2% and negative 4%. So let's head to the day-by-day forecast for the S&P 500. Again, this model is now available in the link below, so do check it out. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to December 19, 2012 to March 19, 2013. So let me point out why these two charts are similar. So what we have here in the beginning of the current trend, we start off above the middle Bollinger Band, and then we proceeded to take a slight dip below the middle Bollinger Band. Next, we average above the middle Bollinger Band once more at this time frame, and then we take another dip below the middle Bollinger Band, nearing the bottom Bollinger Band, and then finally we average above the upper Bollinger Band or middle Bollinger Band towards the very end. So we see a similar pattern here as well. We average above the middle Bollinger Band at the first instance. Next we take a dip. Next we average again above the middle Bollinger Band. Another attempt here, and once more. And finally we have the last segment where we average above the middle Bollinger Band. So what we have here is 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was December 19, 2012 to March 19, 2013. Back then, the S&P 500 was up around 1.3%. So if we head back to the day-by-day probability model, that coincides with this standard deviation of 60% between 0 to 2% up in the next coming days. Again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.